Okay, so hello everyone. Welcome to this macro overview for the upcoming week. Just for the record, we are Sunday, May the 26th, recording this at about 6 p.m. So just here on Sunday evening. So let's have an immediate look, guys, and just see what's going on. There's been quite a strong repricing in a hawkish direction over the last few days or so. And as you can see here, the markets by the end of December of this year is now just pricing in about 2.3. Actually, sorry, just going to the US here. The market is pricing in about 33 basis points worth of cuts, which is substantially more hawkish than, let's say, 10 days ago. So what's been happening? Why is that? Essentially, what we've seen is that since the CPI, which came in on about I think it was the 15th, Wednesday, the 15th of June, which was a little bit softer than expected, the market had priced in about 50 basis points worth of cuts. But what we've seen over the last few days, we saw some, relatively strong initial jobless claims. We saw the S&P PMIs come in quite sort of hot or quite strong. The composite and the services. We've seen relatively strong global growth over in Europe, and we've been getting a barrage of hawkish commentary from a lot of Fed speakers. Essentially everyone's sort of saying, "Oh no, there's no rush to cut, etc., etc." So all that to say that if we look at a few different metrics here, we'll see that the market has hawkishly priced quite a few things. So if we look, it's also the curve has actually bear flattened quite a lot. So let's look at a few curves and things. So what we can see here, this is the US Treasury curve, starting at the very front end, which is the 1 month. You can see that's still pretty much in, I was going to say in a backwardation, but basically in a sort of a flattening kind of situation here. And you see here on the 2-year, you can see if we go out there, this yellow line here is about a week ago. So what you can see is that all across the curve, in the past week, the yields have gone up all across the curve. But most prominently, as you can see here, the change has been in the 2, 3, and to a certain extent, the 5-year tenor. So really at the front end of the curve here. And if we look then at the SOFR curve, which is the short-term ones, you can see the curve here going all the way out to 2033. So about, 10 years or so. 10 years into projecting into the future. So look at this terminal rate here, well above 4%. And what's kind of interesting is that if we look at this, let's say from a week ago, you can see a similar kind of situation here, that has moved up all across the curve, especially especially at the front. And what's crazy, just to put this into context, well, I don't say crazy, but what's interesting to put this into context is something like we can go back. Well, we can do a couple. We can go back to peak sort of dovishness, which, as you remember, was sort of beginning of, let's say, January, something like that, the middle of January. You can see here that at that point, the market had been expecting, pretty swift and very deep kind of cuts with a terminal rate, below 4% and actually a much deeper cutting. So all that to say, something else which I could maybe just show you as well. It's always kind of interesting to look at a few things, just looking how the curve has changed. This is on the CME website, which is always a good one to be looking up here. You can see that if we look at the SOFR tool, the SOFR watch, we've only got now on the SOFRs only one full cut priced in, so almost 2 cuts, but only one full cut priced in, only 25 basis points. And if you actually, again, look at the curve, you can see that that's where we are now, is this red line. Forget the 20 years, a bit sort of weird, but you can see the red line from 1 week ago has gone up, which was the blue line from 1 week ago. So all that to say that, the curve has continued to flatten. And let's have a look now at a couple of yield curves, just to see what's been going on. And so essentially pretty hawkish. And I just want to show you just a couple of different charts here and various things to look at. So if you look at the SOFR, this is the price now, not the yield, on the SOFR for December 25. You can see that this is the daily chart. You can see all these red candles for the past 5 or 6 days. So what's interesting, again, if you look at Wednesday, 15th of May, that was, when the CPI came in, as I said, a little soft, and you could see that the market was getting all excited now. But basically now you can see that it's taken away all of that and actually has gone down quite a lot. The same thing if we look at the curves, we can see, if I just look at, for example, something like, well, actually, let's look at the yields. We'll look at, let's say, the 2-year yield. We can see what's going on here. And basically what's happening is that the market is saying, why is all this? It seems like the market is slowly pricing in the possibility of, not two cuts, but maybe just one cut or 1.5 cuts. And some commentators are even talking about 0 cuts by the end of 2024, which to me seems a little bit on the exaggerating side. I'd say that even one cut, surely at a minimum, must be reasonable at this point. And so we can see here that the 2-year yield is going up. But my point is that if you look at the effective Fed funds rate, when we'll have a quick look at that, let's just go back and have a look at that. Sorry, I'm going to be shifting around between a lot of different things here. Yeah, so you can see that the effective Fed funds rate is 5.33 at this point. So if we look at that 5.33 and we go back then to the 2-year, now remember that the 2-year yield, it technically has to sort of price in everything which will be happening, the market expects to be happening to the curve for the next 2 years. So 5.33, as you guys can see, is essentially up here near this purple line. So yes, we've gone up about 25 basis points in the last week or so, but really you've got to say that, what is the upper limit? If it gets up here, which is around about, the sort of the 5.08, 5.10 kind of mark, which would be a little bit more hawkishness being priced in. But can it really go further than that? Because if it were to go further up, at that point, essentially the market is saying that there is not going to be any cuts for the next 2 years, which does to me seem to be a pretty sort of low probability. So I'm thinking that around here where I've written key zone is probably some kind of cap, but the market does like to overshoot and does like to test limits. So it would not surprise me as we go into the leading up into the FOMC, which is about 2 weeks away, that the market does start to price in a little bit more hawkishness. Now, what could get it to go above that? That would be maybe at the SEP, the Summary of Economic Projections, maybe the Fed taking out all cuts for 2024 and even being a hawkish repricing for 2025. Also, if we continue to get, let's say, a re-acceleration in CPI or something like that, can the market move up into this sort of zone up to near the Fed funds rate of about 5.33? Yes, it can. That would be a low probability case in my estimation. Why is that? Because Powell has said on many, many occasions that the bar to hiking is extremely high. Now, it doesn't mean to say that within the Fed, especially from some of the regional presidents, there's not some kind of dissension. I think that a lot of the regional Fed presidents are a little bit more on the hawkish spectrum, but especially in an election year, I think Powell has made it pretty clear that if inflation does not moderate and they need to keep being as restrictive as possible, his preferred course of action is simply not to cut. It doesn't mean he's going to hike. That would be pretty extreme in my case. But all that to say that that's where we're getting up to now. Something like about maybe up to, so it wouldn't surprise me for this upcoming week if we see a bit more weakness at the front end of the curve. And keep in mind, guys, that we do have the 2s, 5s, and 7s auctions coming up. So the supply is still being weighted towards the front end. So that could put the front end of the curve, just from a supply point of view, because of the auctions this week, under a little bit more pressure. And they're going, because it's a short week, tomorrow's a holiday, of course. Tuesday, Wednesday, Thursday, I think, we could see the front end, especially Tuesday, Wednesday, just under a little bit more pressure, which is not to say that those auctions will fail or have, poor metrics. It's just to say that, the market seems to want to test the yields up to this zone again, which means that the front end of the curve should be under a little bit more pressure. Okay, so at this point, let me just have a look here. Yeah, so I'm just thinking that my base case is that, as I say, these yields on the 2-year go up a little bit more. Now, in terms of the yield curve, I'm just going to put here, I think I've got the 2s, 5s. Is that, yeah. So also what you can be seeing here is a bear flattening. Okay, so we're seeing here on the 2s to 5s. Look how aggressively this is bear flattened over the last couple of weeks. And what that basically means is that the yields are going up on the 2s and the 5s, but at the very front of the curves, the 1s and the 2s, that's going up a lot more aggressively than the 5-year. So those cuts are being pushed out a little bit further, and that, of course, is causing the 2-year yields to go up more than the 5, and it's causing the 2s to 5s to flatten. And now, where could that go down to? I mean, that could even go down to something like about, minus 44 basis points. Something down here could go down a little bit more. That's where that could go down. If we also look here at something like the 2s, 10s, which I believe I have here, the 2s, 10s, again, I think that it could go down here, something like about minus 53 basis points. It can maybe flatten down another 5 or 6 basis points. But any lower than that, I think, would be a stretch, because, again, that would be that scenario that, inflation is actually not only sticky, but is actually re-accelerating to the upside, and that the Fed is maybe even thinking about hiking again, which again, I think is a pretty low probability kind of scenario. And if we look at something like, let's say, the 5s, 30s, I think that could also flatten down a little bit more, maybe down to about the 0 mark. So again, about another, 3 or 4, 5 basis points there. But again, I think that that's going to be an attractive area to maybe start putting on a steepener, because if these curves like the 2s, 5s, the 2s, 10s, and the 5s, 30s, they all flatten another 5 or 6 basis points. That gets us to the point where, as I said, just going back to the outright yield, that we're sort of getting up to sort of, testing pretty much the cap in the 2-year and maybe something in the 5-year, testing up towards about the 468, 470 level up here somewhere, which, as you guys can see, is going to be pretty strong overhead resistance. So what I'll be looking at is to see that, any data or anything we get this week, if the front end of the curve does push up towards these kind of, uppermost limits, I think that's going to be an interesting place to start thinking about steepeners, putting on the steepener trade, and also just buying, let's say, the 2-year outright or maybe the TUA ETF. But of course, keep in mind that probably what would be the real catalyst, we have to see what happens with the FOMC meeting, which, as we know, is still another 2 weeks away. Because if the Fed is extremely hawkish there, more than expected, and if the summary of economic projections, if they take out all of the cuts for 2024 and maybe even don't push those into 2025, that would be considered pretty hawkish by the market. And for sure, we could have, some kind of overextension here and test more to the upside. So let's just see what this SEP is. So we've got another couple of weeks to deal with that. And as I say, maybe it'd be interesting to see how the market's looking at that by looking at the auctions, which are going to be packed into Tuesday and Wednesday of this week, I believe. Okay, so let's look over at the European space. And what's interesting, before we do that, let's have a quick peek. Now we know that the ECB, most of the speakers here, if we look at the ECB here, pretty much even Lagarde was on the wires last week. So we look here at the pricing, we can see that a June cut, you see the 6th of June here, 21 basis points, which is essentially an 85% chance of a cut, pretty much baked in to the market, and everyone at the ECB seems to be agreeing with that. But where we start to get a bit of sort of different viewpoints is the future path. And as you can see, the market is pricing in some more cuts. We can see that by the end of the year, the 12th of the 12th, about 2.3 cuts. So still a little more dovish than the Fed. But it's this period in, let's call it the autumn, sort of September, October, November. The market is not exactly sure whether the Fed will catch up, so to speak, to the ECB, or whether the ECB will be more dovish than the Fed. So that's going to be quite interesting in terms of trading opportunities, is what the market is thinking about the future path of the ECB, because a lot of ECB members have said, okay, great, we'll give the market one cut in June, but thereafter it might be every second meeting. And of course, it's going to be data dependent. So what that means, that has implications for things like the euro, for the differentials, and of course, for, let's say, like the Bunds in the German space. So let's have a look here. I mean, there's the 6 months yield, not so exciting there. But what you can start seeing is, if you look at the yields on the German 1-year here, starting to creep upwards, and you see that on the 2-year, it's actually gone up quite a lot. And what you guys could see on the last, 5 or 6 trading days, that we've actually had almost a full cut being priced out. So, pretty similar to what's been happening over in the US. We've had 25 basis points here, as you can see, being sort of taken out. But, despite the fact that the ECB has said that essentially they're going to be cutting in June, as you can see here on the charts, the 2-year, it has, it's been repriced relatively hawkishly. Also, what we can see is that the German curve, let's see if I can find it here. I think I've got it here. Yeah, there's the German 2s to 5. You see the 2s to 5 has bear flattened a little bit. If we look at the 2s 10, you see here a little bit of bear flattening as well. And if we go out, let's say, a bit longer on the curve in Germany, the 2s 30s also bear flattening. So both in the US and in Germany and the European space in general, there's been sort of a recalibration of expectations that and in the Fed is because, as I said, we had sort of relatively strong PMIs, and also keep in mind that we had German industrial production last week, which is a little stronger than expected, and the PMIs in Europe in general were a bit stronger than expected. So there's a bit of a narrative here that China is starting to do okay. There's some sense that the Chinese government is sort of trying to buy empty apartments, trying to support the property market, and over in Europe, there's a sense that the worst of the slowdown in the economy is kind of flattening out, and that the European economy is stable, certainly for services, but even in the industrial sector and the manufacturing sector is starting to pick up a little bit. And certainly the data in the US continues to be pretty strong. Employment and also services and manufacturing seems to be relatively good. So there's this idea that sticky inflation combined with a relatively robust economy globally, hey, no need for anyone to be cutting particularly aggressively, and that's why we're getting that bear steepening, and that's why we're getting yields going up. And so that's definitely what we have to be looking at. But one thing I would say is that but it would be reasonable to expect that as the ECB is the first to cut, that in theory, the curve over in Germany and Europe should start to steepen a little bit before the US. I mean, that would be the theory. But of course, before we get into that, we'd probably want to see the 2-year in Germany, the Schatz go up to about this level sort of up here, which it kind of tested. Let's see if it can't break out there. So you're talking something like maybe 314, 3.15, just up here. Let me get rid of that actually, just to clean it up. Something up around here, already rejected on Friday. So just going to be curious this week to see if it can't go any further than that, because if it can't go further than that, you say that maybe that's some kind of short-term top. Interesting. And if we we'll have to wait for more commentary from the ECB, because if the commentary is that they do intend to keep on cutting, I mean, that could be an attractive entry point at some point, maybe for a steepener over in the German bonds, or even an outright buy for the front end of the curve, the Schatz there. Okay, just a couple of other things to be looking at here, guys. Those of you who follow these things will have noticed that the Japanese yields have been quietly sort of going higher and higher, especially I think the 10-year is now over 1%. But I want to look at some of the differentials here. So especially if I can find, I've got the German, where are my differentials? So if we look here at the front end of the curve here. So this is the German 2-year, subtract the Japanese 2-year. And as you can see, it's more or less in a range here. But the German 2-year, as we just spoke about, has been going a little bit higher, at least against the Japanese yield. So a lot of the commentary over the last week on Twitter, and everyone has been saying, oh wow, look at the Japanese yields going higher. But the reality is that the German yields have been going higher as well against the Japanese yields. And of course, that's being supported for a cross pair, something like Euro JPY. And you see here that really at this point, I'm not saying it's going to break out too much higher, but certainly we're not getting to any kind of low point down, which would be down here. The critical level, which I spoke about, I think a couple of weeks ago, is about 2.53. So until and unless these differentials come in favor of the Japanese yields, and again, we can look at something like maybe like on the 10-year, a little bit further out. Again, you'd probably want it to close, pretty much below this 1.5 level significantly. That means that that's going to put more pressure if we start to look in the FX space on something like Euro JPY. And as you can see here, well, I've marked it here with a bit of a note, but you can see here that Euro JPY has been pushing higher. And until and unless, as I say, we get on the 10-year differential, maybe below the 1.5, and on the 2-year differentials, maybe below the 2.53. It's going to be difficult here for the euro to be a short against the JPY. Having said that, keep your eye on the differentials. I'll be keeping an eye on these differentials between as I say, the German bonds and the Japanese bonds, because we do start to see those coming in favor of the JPY, the Japanese bonds. For sure, that could be an interesting short opportunity here, Euro JPY. But again, I stress we'd want to see those differentials coming in quite significantly, but that's definitely something to be looking out for. In terms of everything else, if we look at some other differentials here, I've got here the US. I think I've got, yeah, if you look here. So if you look here, at the US differential, the 2-year minus the German 2-year, you can see that it's going up fractionally in favor of the US, but pretty much in a range. If you look at a sort of week over week here, if you look at the 5-year, pretty much flat, and the 10-year differential actually going slightly in favor of the German 10-year. So not too much price action there. And what that essentially means is that that's finding it difficult for the dollar to rally enormously. And you can see here against the euro at least, and you can see here that the euro. There was some like a bull flag. It looks to me like a bull flag in the euro USD space. So that's going to be quite interesting, because if those differentials in the upcoming week cannot go out in favor of the US, it looks to me like the market might take the opportunity to break out of this, what looks to me potentially to be a bull flag on the euro USD, and could maybe break up at least to the, let's say, 109 kind of level, and maybe even a little bit higher. So the euro looking relatively supported at this level. The dollar index in general, had a relatively good week, but, not a huge move on the whole week. Again, I think it's just trading within this range here. You see this kind of pink box here, just trading in a range. Again, up to 105, maybe down to 103.8 or so. I don't see a huge amount of impetus just at the moment for the US dollar. Again, probably have to look at it a little bit more in the bond action here to see what's going on. Moving over to commodities, guys, quite interesting developments, especially in precious metals. I just want to specifically have a quick look at gold. As you know, gold, is very, very strong. But what's interesting, we had a pretty strong reaction, especially the last 2 or 3 days, on Wednesday, Thursday here. Gold coming off pretty strongly. And again, was it the PMIs, the initial jobless claims? Maybe. But so the big question here is that, will that be some kind of double top test, which was a failed double top? But it was, surprisingly bearish. So at this point, if we start looking at, some Fibonacci's, this was always a pretty key level for me, the 2270, 2260 level, which was an initial kind of congruence of this longer term Fib. So for this one here, as you see, about the 3.8 and the 50% Fibonacci level of this sort of impulse there. So that's still for me a pretty key zone, and I'm just going to be curious to see whether gold can come off, as I say, down to about this 2270, 2260 level. That for me, in fact, I'm going to write a little note on that. I'm going to put a little sort of one of my areas of key interest, little orange there, because I think gold should be supported, and that would be an interesting sort of entry point for a lot of people who like gold. Chinese demand seems not to be going away. I think I saw some data last week just saying that the Chinese do gradually seem to be selling their US treasuries, just very, very gradually, sort of winding those down a little bit over time, de-dollarization, all of that. So there's no reason to believe that Chinese and maybe even Indian, even Japanese support, even retail support, apart from sort of institutional and central bank support, will not be coming in there. That could be quite an interesting one. The other thing which is kind of interesting as well is just to see if we look at let's say like some kind of comparative thing here. So we could put, let's say, gold and divide that by I don't know, let's say TLT, for example, the long end. I'm just going to put that up. And what you can see is that gold has been outperforming the long end bonds quite significantly, as you can see, all of this year. And it's come down a little bit just over the last 2 or 3, 4 days. Again, what will be interesting to see if that, maybe finds some support around here, maybe a little bit lower, 230, something like that could be interesting, even like a spread trade opportunity there. I'll have to look a bit more at that chart. But what I'm trying to say is that if we still believe this narrative that the US economy is relatively strong, that inflation is relatively sticky, that the term premium maybe has to go up, that there's still a lot of issuance at the long end of the curve, the case for preferring, let's say, gold, even despite the fact that it doesn't yield anything over the TLT, for example, is an interesting one. So that's something I'll be kind of having a quick look at there. Also, we saw that silver, as I thought, would have a little bit of, we had a little bit of a trade on that, which I've subsequently exited just on this pullback here. But now we're getting to a point where we're getting into a sort of, it's pulled back quite a lot. So what I will throw up here is, let's just say this fib level a shorter term one. And you can see that this level here at about $30.30 corresponds to this latest impulse, about a 38% fib, which of course is a congruence, sort of a crossover with some horizontal support going all the way back to 2014. So what's going to be quite an interesting level this week will be to watch will be something like that level here. And as we can see, it looks like just going to be curious to see what happens over the next day or two, whether silver it gets supported there, because that's quite an attractive level there. The same thing here for copper, also having a pretty big pullback. Again, this level back down here, which is a big fib sort of retracement level, about $4.60 odd. I wouldn't surprise me if that comes and just retests there. But there should be demand for that because there's been a lot of very positive narratives around the precious metal space and copper over the last few weeks. So I think both silver and copper, and potentially even gold, as we go through the week, there could be some interesting buying opportunities there, or at least good risk reward. But what is interesting, just as those precious metals or all metals are coming down, is just the commodity space in general. And if we look at like a generalized commodity ETF, like something like DBC or so, we can see that it's at a pretty critical level because there was a bit of sort of some kind of bullish flag here, which it tried to break up, but it failed to retest its recent high. So it's a bit of a sort of a double top failure. And it's now had a couple of, relatively strong sell days on Wednesday and Thursday. Friday was a little bit flat. But you've got to say that there's a bit of an uptrend here. If it breaks this uptrend, it could first of all retest down the $23 level, $22.95 level. And if it breaks down there, of course, it could come all the way down to 21.75. Now, that would be a very strong support, and I'm not sure it's going to go all the way down there. But the point I'm trying to make here, and this, of course, is going to be dependent on the energy space, and especially oil, because there's quite a lot of oil and energy in the DBC ETF. But my point here is that commodities, including the metals we just look at, they're having just a bit of a pullback, a little bit of a softer thing. And that's kind of interesting. If you consider that in terms of the way that affects yields, because if the commodities globally are having a bit of a weak patch and are not pushing higher and higher, that makes it difficult for the narrative to be sustained of inflation going higher and higher. Because remember that, especially on producer prices, a lot of the input is commodity prices. So if we see commodities coming off, you have to ask yourself, sort of structurally, can inflation, really reaccelerate? That to me seems to be less probable than maybe a flat or diminishing or perhaps slightly sticky narrative. I'm not saying that inflation cannot be flat or slightly sticky, but if commodities globally are coming down, that makes it hard to have a reignition of inflation kind of narrative. So that's kind of interesting. Now, the point is there that should keep some downward pressure on the yields, or at least prevent the yields going up massively, which is why, getting back to the beginning of this video, I think that yields, might reach some kind of capping kind of situation here. But again, just getting back to one of the key commodities, of course, is oil. Oil, to me, listen, global demand seems reasonable. As far as I can see, we've just been in a big sort of range, essentially between, about $80 and call it down to 77, 76. Is that, you could say, oh, this uptrend, it's broken down, maybe. But the reality is, another way of looking at it is to say that we have horizontal support. It's been bought once, twice, three times on that horizontal support there. I was reading something that Saudi Aramco is thinking maybe of selling off, another few percent of the company. That would normally mean that they would want to keep oil prices relatively supported, just to sort of support the share price there. Oil, I don't think there's any particular reasons for oil to collapse. OPEC Plus certainly wants to support the price. The Saudis want to support the price. Global economy, as we spoke about earlier, is reasonably strong demand. Production cuts, at least from the Saudis, are continuing most probably. On the other hand, you could say that there's some cheating in the production cuts, and that oil demand is not massively accelerating. So maybe there's no particular narrative for oil to reaccelerate as well. So all that to say that this range does seem to be a relatively reasonable kind of scenario. If we look at a few moving averages, it's kind of curious. Well, you can see it's going below some of the moving averages. So I would have to say that's a little bit on the bearish side. Let's put it on some simple moving averages. So oil is below But the moving averages, if you look at the 200, slowly dipping down, but the 100 is slowly going up. So not a huge amount of information there. And if you actually look at the just the oil curve, which I've got up, I think I've got it up on the Bloomberg here. Give me a second, please. Yeah, so if you just look at the oil curve, you can see that each dot represents a future contract going all the way out for the next couple of years. But let's look at the front of that curve, especially, let's say, for the next, what's that, year or so. You can see it's still very much in a pretty nicely backwardated state, which means at the front of the curve, the spot price is trading higher than the price for future delivery. So that indicates a relatively bullish price structure in a pretty solid backwardation there. So I don't particularly see any anything there. So just finally, guys, just getting back to some of the charts here, just have a quick look at equities. Now, what I want to look at here, we obviously had NVIDIA, and what I've got here is a bunch of charts, the 15-minute charts. So we have Apple, Microsoft, Amazon, Alphabet, Meta, and NVIDIA. And what's interesting, each of these dotted lines represents a session. So going back 4 or 5 days here, what you can see here is that obviously after NVIDIA's earnings, I think was it Wednesday after the close, that gapped up and essentially never tried to backfill the gap, and is very solid price action, up 7 or 8, 9, 10%. So NVIDIA is doing well. But if we look at the other sort of magnificent sort of 5 or 6, be it Apple, be it Microsoft, certainly Amazon a little soft, Alphabet a little soft, Meta, doing pretty well, but did sell off, but has maintained that. But what I'm trying to say is that clearly NVIDIA, I mean, you can argue that Meta is doing quite well here, but NVIDIA clearly is the leader here. And so that's something definitely to be looking out for, that, is the equity space being held up by, the NVIDIAs of the world, the Eli Lilly, and over in the European space, Novo, for the Ozempic kind of drugs, the obesity, diabetes drugs. So this is very much being led by NVIDIA, and you could say that NVIDIA is leading the tech sector, and you could say that the tech sector is leading the overall sort of equity market. And so the point here is that, sure, okay, VIX is still pretty low, so volatility is low. Okay, great. But the point is that VIX, just one thing to keep in mind, guys, that the VIX has come down for what's at about 3 weeks or so. So yes, when the volatility comes down, that does at the beginning give you kind of a Vanna kind of volatility push, like a tailwind. As the volatility comes down, you have a lot of volatility targeting funds which start to sort of load up and leverage up and buy more. But the more volatility comes down, that effect becomes less and less important over time. And as you can see, that's been the case for the last 2 or 3 weeks. So that low vol is maybe not as powerful a Vanna effect as, let's say, 3 weeks ago, or last couple of weeks or so. But what is interesting here is that, as I say, NVIDIA and tech does seem to be leading the market. So if we just look, I mean, I'm going to put on a weekly chart here, just give a bit of perspective here. So if we look at, let's say, the SPX, you can see that last week was essentially flat, didn't really do much. If you guys, I'll just zoom in here a little bit. So it didn't really fall, but it was like a doji here. But you can see that on the NDX, that was a nice, pretty nice green candle. Okay, so that's good. But if you start looking at, let's say, the Russell, you can see that it had a bit of red, but look at the Dow. So the Dow down, or the big red candle here. So the Dow really, really underperforming. And a lot of people this week also spoke at, let's say, something like the Dow Transportation Index, which really underperformed. So what we're seeing here is that some of the industrials and the Dow and the Russell, the small caps, are definitely underperforming. So it looks like some sector rotation. And then we can see that NVIDIA is outperforming the tech sector. We can see that also the tech sector is outperforming, let's say, the generalized indexes. And you can see that if we do just a couple of, if we look at a couple of like comparisons here. So let's say the Qs and divide that by, let's say, like the Dow, and you can see what's interesting here. You can see this is a weekly chart, just to put everything a little bit more, longer term. You can see here that the technology sector, or the Qs, the NQ ETF, is really outperforming the Dow, like very, very heavily, and pushing higher. But let's say, for example, you can also see just the strength of the tech sector. Let's say you do SPY and divide that by, let's say, the technology XLK. And if you look at that on a weekly, you can see that, this trend of the SPY underperforming the tech sector, continues. And this is going back, another 4 or 5 weeks. This is, remember, is a weekly chart here. So my point is that, equities are sort of doing okay, but there's definitely, I would say, under the hood, some rotation going, out of the industrials and the small caps into the tech sector. And even within the tech sector, as we saw by looking at the the various sort of the leading maybe six stocks here in the tech sector, your Microsofts, your Amazons, and your Apples, etc., there is a bit of divergence as well. So that's definitely something to be keeping out for. And one thing I just would say, if we go back to let's say NASDAQ, you've got to say, well, okay, can this rally continue? And again, this is on a weekly chart. But, I've got this level up here. And if you actually start looking that, we have blue skies above, where can this potentially stall out? And something which I do like to look at is, let's say, the Bollinger Bands and what you guys can see here is that, we are at the top of the sort of the Bollinger on the weeklies, the weekly Bollinger Bands, and you can see that it started to get a little bit of resistance. So, it would be absolutely normal, if even the tech sector, the NASDAQ or this, the cash index here, the NDX, if it actually sort of back tested a little bit here, because, just to sort of see what's going on. So that's definitely be something interesting. And so let's keep a lookout for all of that. So that's about it. But what I would say is that in general, earnings have been relatively good. NVIDIA was pretty good. It doesn't look as though the yields on the bonds can go that much higher, especially at the front end. There seems to be, getting towards a point. We had some hawkish repricing last week, so I think a lot of that is, I don't want to say over, but we've already taken that in our stride. So just put this back on a daily chart here. So the question is, I think if the equities were to sell off, I'm not sure it's going to be some giant correction, 5 or 10%. Maybe it's a 2 or 3%. Maybe it's going to be led by the small caps and the industrials, and it could be sort of a buy the dip kind of situation. But definitely keep an idea on the Magnificent 6 and 7. Just see what's happening between NVIDIA and those other ones. And also just have a bit of a look to see what's going on with the commodities, and if the commodities remain relatively weak, by which I mean some of the industrial metals and silver, things like that, and also oil and the energy space, if the commodities in general are staying relatively weak, of course, keep an eye also on grains. That assumes that the yields and inflation can't go up too much in theory. Now, if they can't go up too much, that should be relatively supportive for the tech sector, and maybe equities slightly more broadly. So any sell-off, I think, should only be a 2 or 3% sell-off if it comes, and it could be a buy the dip situation. So finally, guys, just want to look and see, we have the Fed, I think, this Friday going into blackout mode. I think this Friday, let me just see if there's any headlines. Again, as I say, it's about 6:37 here on Sunday PM. So just look at what's coming up in the next week. Not a huge amount of data. We get the conference board. Interesting to get a bit of an insight into what the American consumer is sort of feeling. We do get some GDP, but it's kind of second revisions here. As you can say, it's the second reading. What will be interesting is on the 31st, which is, I think that's, hold on, let's do this at 27, 28, 29, 30, 31. So on the Friday, we do get some PCE deflator information. So that could be quite interesting there, core deflator, the PCE core, probably the most interesting thing this week. And there's a few Fed speakers. So that's about it, guys. Hope that was useful. As I say, let's keep an eye on the auctions, the short-term auctions. Probably they're going to go relatively well, on a Tuesday and Wednesday. And I'll be personally keeping an eye on a lot of the metal space and the energy space and the technicals. Maybe it's going to be another week which will trade relatively technically. And I will try and get a new camera because it's still making me look like an orange beetroot. Okay, guys, take care. Have a great weekend. Of course, the cash markets are closed tomorrow in the US for Memorial Day. Thank you.